markets are flat this morning, but we're up about 13% since Election Day. Investors are awaiting President Trump's address to a joint session of Congress tomorrow night. It all happens at 9 p.m. Eastern. The president is expected to shed some more light on his approach to speeding up economic growth. I spoke with Treasury Secretary Steven Rees over the weekend, and here's what he told me to expect.
The most important issue is economic growth, and the president is very, very focused on us getting back to sustained long-term economic growth. That the American economy has been too slow for too long, and we're going to start with tax reform. We're focused on regulatory relief, and we're focused on just a whole lot of changes to make the middle class tax cuts and to make business competitive.
Joining us right now is JPMorgan Private Bank head of U.S. Equity Strategy. Steven Rees is with us. Steven, good to see you.
Great to see you.
Market's up, what, 13% since Election Day?
5.5 year to date.
What do you do now?
Yeah, we continue to see opportunity in the U.S. The earnings that we've seen so far have been very, very good, up about 7.5% in the fourth quarter year over year. That's the best growth we've seen in the last 2 years. So do we think the market rally year to date is justified? Yes. Where do we go from here? I think you need to be a bit more selective, looking at places like small cap, technology, energy, telecom, some of the areas that have lagged year to date. But yes, we still see opportunity.
How do markets and investors view President Trump?
Well, obviously the market's very optimistic in terms of the potential upside. I think from our perspective, the good news is a lot of that is not fully priced in yet. When you think about tax reform and deregulation, this is significant upside, not just to the earnings outlook, but also corporate confidence that could translate to increased capital spending.
Yeah, you mentioned those numbers in the fourth quarter. Yeah. That, sports fans, is pre-Trump administration. I mean, you're talking about some serious growth numbers in Q4 that is all pre-changes.
6% earnings growth in the fourth quarter.
It's insane. I mean, Maria, you're talking about this explosive potential that is sitting in the S&P 5, the S&P 6, Stephen, where you have the ability to see why, in my opinion, prices can be supported here despite the haters, as the kids say, right?
I think we get to high single-digit earnings growth this year without any policy changes.
That's true.
When you start to think about
high single digit,
and it gets to mid-teens from a lower tax perspective. So there's a lot of upside still.
What do you make of what the Journal writes about today, that you've had bonds and stocks both rising and moving in tandem with one another? The argument they make in part is that people are betting, by buying Treasury bonds, betting that riskier assets are overvalued at this point, and they're in store for a correction. Even more so if the Trump administration can't push these kind of very growth-oriented policies quicker.
Yeah, we're not surprised. It's interesting that it feels like everything is working in this environment, but we didn't start the year with a significantly optimistic view on interest rates. We thought the buying from Europe and abroad and Japan would keep them relatively low. So, so far I think we're comfortable with where we are. We don't see a major correction on the horizon. And I think we do think rates gradually move higher, but not to a level that disturbs the equity market performance.
Scott, you mentioned business confidence earnings. How much of this is impacted by the deregulation conversation that has really been dominating the last couple?
I think the financials rally, there's a lot of enthusiasm around what deregulation means for profits there. We don't think it's fully priced in yet. Based on our math, we think there could be 25 or even 30% upside to the financial sector earnings over the next couple of years from deregulation. It's hard to model. You can sort of work through what the expense reductions might look like. But when you talk about increased loan, increased confidence from not just the financial sector, but from all the companies out there demanding capital, it gets to be quite interesting.
Wait a second. Did you say 25 to 30% upside earnings for the financials?
From a deregulation perspective and lower tax perspective over the next couple of years, we think that's totally
and that's fair.
25 to 30% earnings upside.
Well, because the financials have been hammered, Maria. They've been in their shell, and I think it's a good point. And to Dagan's point, what if the yield curve continues to steepen? You made a great point about how yields have come back down, which is really weird, not only in the United States, but globally. Look at the German 2-year just last week or the week prior. All-time lows. Hello. I mean, there's an unbelievable movement in yields with regards to downward pressure. But if we get a re-steepening, let's say, Stephen, of the yield curve, financials, #1 beneficiary.
Don't underestimate rates, regulation, and better economic growth.
Wait, you missed one. infrastructure.
Exactly.
Somebody's got to pay for these infrastructure plans, a $1 trillion plan. The banks are going to fund it.
Well, I think that's icing on the cake. I think there's some hesitation around the infrastructure spending. Can Trump get that through with all the tax cuts that he wants to pass through first? But I think you're right. I think longer term there is additional upside.
That's one thing the Democrats actually could get on board with is infrastructure.
Well, they love spending, so why not? I mean,
well, the only danger is
it's not their money.
Is if you cut taxes and increase spending, and you don't have any kind of revenue offset in the tax reform package, that ultimately will be troubling to the bond market.
That's why you're talking about border adjustments and other reciprocal taxes and everything else to partially offset that.
So what's the fly in the ointment? What changes anything? What are you worried about?
You know, I think, trade policies, that's a bit, less of a concern given how, what we've seen year to date. I'm a bit concerned about inflation coming back if we do get the border adjustment, what that means for consumers and pricing, although I think that feels like it's losing a bit of steam.
Do you see gridlock at all? I mean, Congress maybe not quite being on board with some of the Trump initiatives, or what?
Well, gridlock, but from what perspective? In the current form of what's been proposed, or are they able to come through with something a little bit less optimistic? I think they can get there. We're still pretty optimistic that tax reform will happen this year.
Look, you got to believe these guys know they have a window here. They want to get things done. That's certainly what you're hearing from the Paul Ryans and Kevin McCarthy's of the world.
To point out the top story in the Journal today, the GOP's new plan to repeal Obamacare is to dare federal Republicans to block the effort. I dare you. Yeah. We will shame you and take you down. They're saying that they're their own, essentially. So they're cognizant of cohesion. Yeah. And that's the focus this week, health care, right? We'll talk about that. Steven Rees, good to see you.
Great to see you.
Thanks so much for weighing in. Steven Rees, JPMorgan there.